Okay. Hi, everybody. Thank you so much. I have Ethan Gao here, and we're so excited to have him. He has a background in law and economics from Cornell, and he has been doing, let me go ahead and just pull it up. He has been doing tons of private lending and hard money for himself and other investors. Let me, don't want to mess it up here. So, um, basically, he has originated and funded over 170 private loans to real estate investors in the Houston area. So, primarily that's been in the last 5 years. Additionally, he's purchased and rehabbed over 100 single family homes in the past 4 years and has extensive experience in syndications and private equity sponsor. So he's also a licensed with the Whole Life and IUL agency. And so we are so excited to have Ethan go ahead and delve in a little bit more about whole life and IULs and how it can help your business and your wealth, accumulation in the future.
Thanks so much for having me.
Yeah. All right. So yeah, if you can go ahead and just kind of jump in and give us a brief overview of kind of what it is in the beginning, and then we can go into some more specifics about kind of the pros and cons. Can you utilize it right away? How long does it take, and why, if you are investing in real estate, why is it something that you should be using as a tool in your business?
Sure. I'll start with a little bit more background. So I myself have owned life insurance policies for over 9 years. And then I became a licensed agent about 5 years ago. So I started on your side of the table as someone, being pitched products and evaluating products and then going online to research products and trying to figure it all out. So that's where I started. And then, I did it, and then I liked it so much, as I became an entrepreneur, as I quit my corporate job, I became a financial advisor, and whole life and life insurance and disability insurance is one of the aspects of financial planning that we address in our financial advising practice. So more specifically about life insurance. So most people know a lot about car insurance and home insurance because it's, that everybody basically has that. And then a lot of people understand term insurance, term life insurance as well. So what, a good analogy is, term insurance is something you rent for a specific period of time, whereas whole life or IUL or any permanent product, it's considered permanent. You have it until the rest of your life, and that's the point. So, from a statistics standpoint, you're going from a low chance of collecting, or not even you, but your family has a pretty low chance of collecting on you during the term life policy versus on a permanent life policy. It should actually be guaranteed that they will collect something because it's good for the entire lifetime that you have. And when you die, the payout happens. So reasons for that. And, when people kind of just compare numbers a lot, they're not comparing apples and oranges whatsoever. When you go Google Dave Ramsey or Susie Orman, they all say permanent life insurance is terrible, the costs are too high, but they're really comparing apples and oranges. It would be similar to you comparing the rental cost on a car versus just buying a car. I mean, those numbers, they're just comparing apples and oranges at that point. And then specifically, the reason that term life insurance is quote unquote cheap is because the vast majority of people don't die during the term. If they did, life insurance would be astronomically high. It would be, the example I give, I always like to pick on my wife. She's gotten into multiple car accidents. One in particular, she totaled her car and the other guy's car. So we 1,000% made back our insurance premiums from Geico. 1,000%, maybe even 10,000%, right? Because we paid those premiums for years. She has one terrible accident, and then, Geico has to pay out $70,000. So it's because people don't crash their cars every single day. And it's because your home doesn't catch fire every single day. And it's because people don't die every single day that term life insurance can be offered at a, relatively small per month or per quarter or per year price, depending on how you pay it. So that's kind of the general distinction between a term policy, which most people understand, versus a permanent policy, which, could be subdivided into whole life and index universal life. And there's other types of permanent insurance as well. So that's the first kind of delineation between the products. And then between a whole life and a IUL, which stands for Index Universal Life, the key difference is that IUL pays a dividend based on the performance of a specific index. That's why the word index is in the name of the policy. And then index is usually like a stock market index, S&P 500, all world index, whatever. And some of these products are extremely complicated derivative products. And you can get extraordinarily complex and mix and match indices, mix and match time periods, et cetera. So that's kind of the key distinction. It's the return you make on it is based on the performance of some sort of public markets index. And what the life insurance company is actually doing is it's trading, calls, options, swaps, derivatives, other things behind the scenes to give you a synthetic return based on what that index has done. That product's been around, 30, 40 years or so, has some decent history. Usually, there's always a cap return. So if the S&P 500, last year was about 20-25% return, the life insurance company won't give you the full benefit of that. So it'll cap you at, 10, 11, 12, 8, 7, 6. It just depends on what policy you have. The counterbalance to that is if the S&P went down or the stock markets went down, they just give you a 0, so you don't take the full brunt of the loss. So that's the trade-off you get. The lowest you get is 0, the highest you get is capped. So the S&P 100, goes, 100%, you'll never get 100%. You'll get some portion of that. A whole life policy has been around for something like 100 years. That's just a more vanilla product. It's your return. The return you get is based on the overall general performance of the insurance company. So the insurance companies make money from underwriting life insurance, like we said, with term policies. Not everybody dies, so they make money off of selling people term policies, and whole life and other products. Insurance companies usually also issue quite a lot of annuities, so they make money off of that. Insurance companies make money off of investments, all the premiums you pay in, those get invested in corporate bonds, real estate, et cetera. So your general return is going to be based on the overall return of the insurance company, and typically it's just basically a proxy for interest rates. So as interest rates go up, the dividend rates should go up. Interest rates go down, rates go down. It's usually a 18 months to 2-year lag. So for this year, for example, everyone's expecting the Federal Reserve to hike interest rates 3 times or more. You will not immediately see that in your life insurance policy. You will see that effect maybe a couple of years later.
Not know that.
So Valerie, I guess one of the questions was, why would putting money in a life insurance policy make sense? Was that one of the questions, I think, especially for real estate investors? Or
yeah, exactly. So why is this a tool that is something that real estate investors should take into consideration, when they're building their businesses? And I like to kind of be transparent. So many people talk about how when you get into whole life and IUL, you can loan against it, and you have all these things, but people don't actually tell you that it's a long-term play. So kind of explaining the benefits, today, tomorrow, down the road, and then, best ways to utilize it. And I've also heard that 401ks you can loan against as well. So maybe just kind of answering that question of why it's better to have a whole life or IUL to do the lending against than an actual 401k.
Okay, sure. We'll talk about the 401k first. Most corporate people have those. So 401k as a tax deferred vehicle, generally, sometimes the employer will offer Roth. Typically, I don't know if it's a law or if it's just most plans are this way, but typically your max loan is 50K. So I used to have several $100,000 in my 401k when I worked as a corporate lawyer downtown. And, as I started investing in real estate and as I came across really good deals, I just kept on looking at my balance sheet and where I could draw liquidity and money from. And I actually took a loan against my 401k, but, I had several $100,000 in that 401k and my max loan was 50K. So I can't remember if that's a specific law that limits that or just the vast majority of plans only permit you to borrow, 50K. So number one, you won't have full access to what you put in. Number two, I think the way it typically works, and again, each plan is going to be different. Every employer runs it differently. They have different administrators. The way mine worked was I basically paid myself like a 4% interest rate. So it didn't really matter what the interest rate was because I ultimately got the money back into the plan, which was my own money that I'll get out later. So, whatever the interest rate was, if I'm paying myself back, it wasn't, that big of a deal. I do remember there were quite a few fees associated with it. I got charged various administrative fees for taking the loan, et cetera. So that's a 401k, right? And 401ks, your employer basically dictates what, or the plan administrator and your employer dictates what you can invest in. So many times it's, they give you like 12 different mutual funds. Sometimes they're not even the best, right? So I've seen, just from our financial advisory practice, especially smaller time employers, they just, sign up with whoever administers the plan and they don't even have the best product. So I've seen S&P 500 mutual funds that should cost, 1 to 3 basis points as a fee, be much more than that just because the employer wasn't big enough or wasn't sophisticated enough to choose a better plan. So there's people out there who are basically investing in the S&P 500 in a 401k and paying way more for it than what you could just do, logging into Vanguard.com or Fidelity.com, which is just kind of a very not ideal situation, right? Because as a plan, you should hopefully get better discounts versus what you could just get walking off the street into a retail shop. So that's 401k. You're basically forced to invest in the public markets, stocks or bonds in some way. Typically, I mean, I've seen a little bit fancier ones here and there with annuities and random stuff like that. But typically, you're basically stuck with stocks and bonds and not the best fee structure. With a whole life or index universal life, when you borrow, and again, it depends on which specific type of life insurance policy you have and which type of or which life insurance carrier you're at. So sometimes the way it works is you are literally borrowing your own money, i.e. they take the money out of the plan and they lend it to you. So you're not getting credit for having that money work in the plan. And that typically is not the right way and not the ideal way for us to do it. We prefer the ones where when you borrow against the policy or you borrow from the policy, that you're still getting credit for what is actually in the policy, and then you just pay a loan charge. And what we really care about is what do you expect to make in the policy versus what you're paying for it, right? As real estate investors, we all understand leverage. If I borrow 100K at 5% and then I buy a rental property and it yields me 6%, or the appreciation I expect to be 10%, then I'm actually making money off the spread between my borrowing costs and what I make in my investment. And that's the ultimate key in life insurance as well. Over a long period of time, your rate of return within your policy should be higher than what your rate of borrowing is. And if that's the case, then you would really want to put in as much money into the policy as you can, because, like with real estate investments, if you can borrow a bunch of money and then immediately go invest it and make more, why wouldn't you want to do that? So that's the general theory.
And one of the key pieces that makes it so powerful, kind of you explained the two, yeah. So you can borrow money against, and the return that you're getting from the rental property, you want to make sure is going to be higher than the interest rate on the loan you pull against. But you'll also be making interest off of that full IUL or whole life amount. So if you have like $200,000 in it, you're still getting that appreciation every year from that whole amount, even though you borrowed 100,000.
That's exactly right. Yeah. That's very important point.
Spreads on that as well. So that's one of the key pieces that I love is that not only are you utilizing your money from the lending terms and your interest rate off of that loan, you're making sure that you're offsetting by your investment, but you're also still appreciating it at the full dollar amount.
And again, remember, Valerie, not every policy works like that, and not every insurance company works like that. But the way you described it is the way that we typically want to do it.
Yeah.
Right. Because otherwise you're just borrowing from your own money from yourself and paying yourself an interest rate, which isn't nearly as sexy as being able to have the money work in multiple places at the same time.
Yes. So if someone wants that type of whole life or IUL, they need to request it specifically or talk to their agent about that's their plan.
Absolutely. I mean, so number one, I guess one point I'll make is, because we're talking to real estate investors, the life insurance industry is relatively similar to the real estate agent industry. So it's very commission driven. The kind of dropout rate in the career is very high. So a lot of just like a lot of realtors, as you guys know, aren't really that great at their jobs, and similarly, a lot of life insurance agents probably aren't going to be that great at their jobs either, based on just the structural ways that this works. So also, additionally, just because of the way life insurance works, life insurance companies have basically just outsourced their sales departments. You can't really call most life insurance companies and buy a policy directly from them. I actually did this 9 years ago. I remember distinctly, I called several life insurance companies and I basically told them, hey, my name is Ethan Gao. I'm a wealthy attorney. I know what I'm doing. I've done all my research. I heard life insurance agents make way too much money. I want to buy this policy from you directly to save the commission. And they all laughed at me and they said, sir, that's just not how it works. You have to call, a local office, and, you buy it from us directly. You buy it from him. You buy it from some other guy. You buy it from your uncle. There's no specific charge that you pay. Like, we handle that internally. There's can't get volume discounts, or you can't really do that. And I said, okay, fine. So I actually called several different agents to my law office downtown, and I just interviewed them basically in a row over lunch or something. I liked one guy the best, and I bought a policy from him. And then that's actually the team that I'm now a part of. So I started as his client, and now I'm part of the team. I joined, over 5 years ago. So I guess one of the points I'm making here is also there's just a lot of different policies and a lot of different life insurance companies. So they're not all the same. Even though it might seem like it should be, it really isn't. It's almost like your home insurance and your car insurance. I don't know how nerdy you guys get, but there's quite a few different toggles that you can do to get an ideal policy off of anything. And life insurance is the same. The products are just different.
Yeah, which is why I absolutely love that we're doing this, because I want to make sure that everyone truly understands what type of vehicle tool this really is. And exactly that, making sure you're asking the right questions and setting yourself up exactly how you're supposed to utilize it in the way that it's truly effective. So that's super helpful.
And then, people's circumstances change too. I'll just give you more about my own story. So 9 years ago, when I bought the first policy, I remember my advisor, his name is Luke, and that's the team that I'm on. I'm on his team now. I remember he explained to me the borrowing provisions of the policy. And he told me, hey, I can pledge it. You can borrow directly from the life insurance company. You can go to the bank. And I just remember telling Luke, I'm like, I don't really ever have to borrow from this. I'm not worried about this. Like, this is just money I have in the bank. I'd rather have it in a life insurance policy. Makes more money than the interest I'm making at the bank. Plus, there's some tax advantages. The interest at the bank, I have to get a 1099 INT every year, and I have to pay interest on it. The earnings in the life insurance policy, I don't have to do that. So I said, look, Luke, I don't really care. Like, this is great that you told me, but I'm just going to file this somewhere and I don't really care. And then 2 years later, I got into real estate and I was making all these hard money loans to people and, making, 14, 15, 16%. And I remember calling Luke and I was like, remember 2 years ago when you told me how to borrow for my policy? I actually really need the money. So walk me through how to do that again. So that's just a short way of saying, even if you don't anticipate having to borrow, still purchasing the type of policies that maximize the ability to borrow is not a bad idea, right? Like, why not take that free option while you have it? So I'm really glad that I bought a policy where I could pledge it to the bank and get a very low interest rate, right? If I bought one of those less ideal ones, because my advisor just said, well, yeah, hey, you told me you never have to borrow from it again, so I'll just give you the worst one on that specific parameter, then I would not have been able to use that for my real estate investing.
I'd like to go in a little bit specifics on expectations of once you get your whole life in IUL. So kind of like the maintenance to keep it going, how long it truly takes to be able to lend from it, kind of like the financial obligations of, acquiring or maintaining it. And then, like I said, like, how long does it truly take to build, when someone gets into it, what are they expecting time-wise to actually be able to utilize this tool?
Sure. So there are several policies that we really like for clients, especially real estate clients that want the most flexibility and the most ability to access cash to use to invest in their businesses. So they're what's called high early cash value policies. So there's one example I'm thinking of right now that we recently did. You can put in $100 or so of, you can put in $100 of premium as your annual premium, and then your cash value will be $95 the next day. And then we can pledge that to a bank that specializes in real estate, or I'm sorry, that specializes in insurance lending, and they'll lend you a borrowing base revolving line of credit of 95% of your cash value. So basically, long story short, if you do the math, 0.95 times 0.95 gives you like 0.905. So basically, within a week or so of starting your policy, you will have the ability to borrow about $90.5 out of the policy at a very attractive interest rate, which currently is 3%.
So you said that you have banks that utilize the IUL or whole life as collateral. So that's how you'd be able to loan against it. So you're not actually being able to pull your money out like a typical, like how you typically utilize it. You actually pull your money out of the IUL. You wouldn't be doing that. You'd be using it as a collateral for a bank to use that as a loan.
Correct. It's called a collateral assignment. So let's address whole life first and IUL slightly differently, because the mechanisms are pretty different. So with a whole life policy, what it really is it's just a holder of cash value, and then there's a death benefit at the end. So the banks will view that cash value as steady and consistent because they understand life insurance, and not every bank does, but the specialty insurance banks certainly will. So that's why they give you a 95% loan to value on it, because they basically think it's close to cash or as close as possible, right? I would challenge anybody to go find an asset where they can pledge it to a financial institution for 95% collateral value or higher. That's not actually cash, right? Mm-hmm. So I recently, last year I got a home equity line of credit against my house. They gave me like 60 or 70 loan to my appraised value, and then I think they dinged me for some reason and became lower. Typically if you're buying real estate, you can you can borrow about 80% of the cost, and then you have to put in 20% down. If depending on the asset class, you might only get 70. Even borrowing from your stock portfolio, you're not going to get 95. Borrowing from your bonds, you're not going to get 95. So with a whole life insurance policy, you can borrow 95. And that's from a bank. If you just wanted to borrow directly from the life insurance company, you would get 100% of the cash value as what you can borrow. So you can borrow even more from the life insurance company. Now, the reason we do it from the bank is because, number one, we want the money to still work within our policy, so it's not taken away from our policy. Just like when I got my home equity line of credit from PNC Bank, used to be BBVA, my house could double in value the next year, but the bank doesn't get any of that additional appreciation, right? I only just pay them 2.5% interest. That's all they get. And that's the same when you pledge a life insurance policy to a bank. They just get the collateral only. They don't get any of the upside and appreciation within the policy. You as the owner of the policy do. And so typically we've also found, just, at least in the last 9 years that I've been very active doing this, and, we can also look at historical data, it's been cheaper to borrow from the bank than it is to borrow from the life insurance policy. With an IUL, most of those that I've seen, the borrowing provisions actually do remove the money. Number one, the vast majority of banks won't lend against the IUL because they find that to be a little bit more speculative, because it's actually being invested in essentially derivatives of security, so it could move up and down. Today is January 26, and I think last week the stock market fell like 10%. So you might have had $100 of cash value last week, and then yesterday you had 90. So a bank doesn't want that fluctuation in its collateral, so they just won't lend. So with an IUL, you're usually borrowing then from the life insurance company itself, and then that, the ones that I've seen typically remove a portion or all of the money you're borrowing from what it's actually invested in. So now you don't get the, what Valerie was talking about before, where, what you were invested in, you would get that return. You've now borrowed out of it, so you're not earning that anymore.
You can borrow out of it and you're not earning that anymore?
Correct. So like I have a policy that's very similar to an IUL. It's not actually an IUL, it's called a VUL. When I borrow from that, it's a MetLife policy. When I borrow from that, it actually sells it sells what I'm invested in, which is the S&P 500. It sells that, and then it gives me a loan. So I am no longer earning what the S&P 500 is in that policy anymore. All I have is a loan against it. And I've tried pledging that policy to every bank that I meet that does insurance lending, and they just say, well, we don't want to take it, because of what I described. There's too much variability in the collateral value, so they don't want to lend against it. So in that policy, I am stuck only borrowing from the life insurance company, and it's not the ideal borrowing mechanism.
Yes. Yeah. Okay. Yeah, because you truly want, the beauty of it really is the ability to borrow from yourself at a low interest rate into
and have it. Yep.
Yeah, and having it still appreciating and earning on its original amount, plus whatever you're investing into.
Yep.
It's also creating income or appreciating as well. And so you're getting two appreciations with one loan with one interest.
Exactly. Yeah, that's the ideal situation. And with a lot of IULs, you don't quite get that.
Gotcha. Yes. Okay. So whole life is definitely kind of a little more flexible and better in that area.
It's it's just superior borrowing ability.
Mm-hmm. So when would an IUL kind of be a better tool for someone?
If you really just like stock market and you want to be able to make a higher return in your life insurance policy, because in theory, if the stock market goes up 10% every year, you will do better in an IUL versus a more standard whole life. I think, though, if you compare the historical data, it comes out pretty close. And then it just really depends on which IUL you have, because you're also taking a little bit of risk, right? Because most of them do what's called point to point. So let's say we bought an IUL today, January 26th. So today we have a Federal Reserve meeting. So the central bank may actually crash the market. So let's say they crash the market. I buy in today. I get a super low basis. So I just really time the market really well. And then January 26th of 2023 is when they do the point-to-point analysis and tell me how much cash value I've been earned. So if I buy in today at a low, and then January 26, 2023 is a high, then I've just done phenomenal, right? But let's say January 26, 2023 was really terrible, and then whatever happens, I'm down. So just within a 1 day, 2 day difference, you have a variability in your return.
Crazy.
Just like if you're trading stocks, like if you could have bought Tesla at $2, you'd be rich. Or if you bought Bitcoin at $2, you'd be rich. Right. And then if you know the next one, please call me. If you got that tip, please call me.
I'll let you know when it starts going up, right? So then it will keep increasing. So just for simplicity purposes, the whole life is a little bit more of kind of safer to a lot of individuals. So you're not actually, your potential increase of your interest on your plan probably isn't going to be as high, but it's showing that it's kind of just as high as an IUL. But typically they state that it's a little more conservative. And so you're able to use that as a collateral and have a lending against it. And so the IUL is considered slightly riskier because it has the potential to go up and down a little bit more. And so it's not used for a collateral, but you can still loan against yourself from the IUL policy. Banks just don't use it as a collateral.
Yeah, that's a pretty good summary.
Okay. I just want to make sure I have it.
So you have the just like with any public markets investing, you have the chance of getting a much higher return quicker, but again, you also have the chance of getting a lower return slower. So it's just it's just different.
Yeah. So the IUL never goes below 0. Does the whole life ever drop below that?
No, contractually, you basically have vast majority of life insurance companies, you have a contractual guarantee that it can't go below. So even if the life insurance company does terrible, let's say they just they only insured people that had massive COVID risk and all those people died, then they would their earnings would suffer because now they paid out a ton of claims from their money, and now they're running short of cash. Just a terrible example of the times or whatever. they would still contractually have to offer you, X% rate of return. So you would still be making something, even if that actually happened to them and they did horrible.
Gotcha. Okay.
Whereas an IUL, you would literally get a zero. You just get like a big, you had $100 cash value. The next year, you stay at 100.
Yeah. So it didn't go up, but it didn't go down. Your money
Didn't go
is
down.
still just sitting there.
It's still it's at the same price point, or it's the same value point. And then IULs, you'll actually see more cost of insurance come out. So over time, typically the cost in the policy start increasing as you age. So you'll get a zero, and then you'll get like a negative charge for your cost of insurance as well. But your investment portion would have stayed the same. So if you invest at 100, you'd be stuck at 100. You wouldn't be 99. You wouldn't be 101. But later on, your cash value will dip because it's going to subtract out a cost of insurance charge every year.
When does age start becoming a factor in these plans?
All the time. It's like when it's like the joke of when they say, when's the best time to buy real estate? A billion years ago. When's the second best time? Right now. Right. And then I'll give you my personal story too. I think I shared it with you. So when I bought my first policy 9 years ago, I had the highest health rating. And then I bought my second policy 4 years ago. I had the second best rating. And I bought my last policy last year, and I had the third best rating. So what I've done is I have just systematically cost my kids and grandkids a bunch of money. What I should have done is just bought the largest policy when I had the best health rating 9 years ago. Or at least I should have bought a call option on my health, so that later on, as I had more money and wealth and I had more money to put into policies, that I would have locked in my top health rating.
That's interesting. You can do that?
Yes.
For how long?
10, 20 years, depending on the life insurance company. So it's one of those situations. So let's say I did that. Let's say I was really smart and I did that 9 years ago. Let's say I had full insider information on my genetics, and I really knew how things were going to play out. I should have bought that option. And then now, even though I'm at the third best health rating, they would still sell me life insurance at still my current age, but still giving me the best health rating. So that would actually make quite a meaningful difference in the returns in my policy.
Interesting. Okay.
And for the vast majority of people, their relative health does not do better. Typically, people's health, especially on a relative basis, declines overnight. And then you have random events and genetic events as you hit your 30s, 40s, 50s, like, heart disease, cancer, just random things start happening, most of which are not good.
Yeah. So if you're in a top 1 or 2 peer health-wise, you should lock that in, because it's not going to get any better.
Correct. It's rare. I mean, I'm sure it happens, but statistically, it's very rare.
Exactly. I would be curious to see who's actually has gone the other way, for sure.
I'm sure it's like probably 5% or something like that, but for the 95%, it doesn't go that way.
Yeah. So you said going into like the highest policy when you were at a higher health rate. So kind of give us an example on some of those policies and the financial obligations into them.
You mean like my policy? The ones I have?
In general ones, like maybe something that maybe a smaller company could start out with, or what's primarily requested, or kind of what you see across the board.
Sure. So the process is you would submit biographical and financial information about yourself. You would then submit, names of doctors, and because they do have a health underwriting, health underwriting. So once the life insurance company gets your financial information, biographical information, doctor's records, they also simultaneously do a blood draw, urine sample, kind of like an annual physical. Somebody can come to your home and office, like a traveling nurse type can do that. They get your blood and urine draw, and then they can see kind of where you are in health ratings. Sometimes it's a small policy, or depending on the life insurance company, it's really algorithmic underwriting. They just that's really all they need. Other times, if it's a bigger policy, they'll have an actual person at the life insurance company review the doctor's records and really try to understand your health and the risks associated with it. So like mine, for instance, I have sleep apnea, so that automatically, doesn't permit me to be a top health rating or a second to best health rating. So, even though I submitted like documentation about, controlling it, et cetera, so somebody manually reviewed it and then still decided, hey, Ethan, you get third best. That's the best you're going to do. right? So this process takes between 1 month to 2 months, depending on how fast doctors' records are. That's usually the hang up. Scheduling a traveling nurse to come to your house or office isn't that hard. The hang up is usually with which hospital system you're with or where your doctor is, and how quickly they fax over or email, or well, typically they don't email, they're usually faxing records over. So that's the process. So I usually tell clients, expect a 1 to 2 month, from the day you submit paperwork to the day you actually pay, get your policy.
So with that, when you're initially talking to clients and providing them kind of tentative plans, what do you take into consideration doing those estimates for them prior to getting all that information back?
Sure. So typically, we do just specific insurance for clients that just want that, but we typically are also doing comprehensive wealth planning. So we're looking at the client's financial information anyways, because we're going to do a financial plan for them, or we might be managing their money in the stock market or taking over their IRA, or what have you. Typically when we talk specifically about life insurance, we're really just talking about kind of income, net worth, the amount of money they want to put into a kind of fixed chassis, fixed obligation, fixed return type of vehicle, what their need for liquidity is, and then just generally what their health is and what their genetic history is, right? Because if, let's say somebody, they're really good health now, but, both their parents have, massive diabetes, cardiovascular issues, statistically, they're going to have bigger chance of that issue going forward. So, somebody like that, I would definitely tell them lock in your health rating while it's really good. Versus, somebody whose, parents are doing great, grandparents done great, live to 150, that those people probably are fine.
Yeah. That'd be awesome to live to 150.
I don't know if how good your quality of life would be starting at 90.
That's true. Oh goodness, that threw me off for a second. So what does it cost, or is it like a percentage to lock in your health rating?
So the cost ends up, so the way to do it, it's typically called a convertible term policy. So what you're doing is you're buying additional term insurance, and then you're paying a premium to that for the option of locking in the health rating. Now, the premium is going to depend based on kind of what's going on with just health. It's too hard to say, right? But there is a premium. So let's say me 9 years ago, I bought 5 million term policy that I could then convert at my top health rating at any time that I wanted, or within 20 years or so. So I'd be paying what the term policy costs plus a premium to that. Is it worth it? For me, certainly. I mean, that's relatively small cost versus what my returns would be in my life insurance policies would have definitely been worth it.
Okay, I was going to say, yeah, for an additional premium that you're paying basically from the get-go onwards.
Yep.
And then the loss of having that, your health declining. So they really truly do offset each other.
It is a very asymmetric return. It's, if you guys do option trading in the stock market, you can put in like $1, like it could be a 1 to 100 spread, right? So it's not a, it's not like I'm paying $50,000 to then save $50,000. That would be stupid. Nobody would do that. That would be a terrible deal.
Yeah. Yeah, that's interesting.
It would be paying $50 for a chance of saving $50. That makes it even worse deal, right? So that's not how it works. It's going to be a pretty dramatic multiple.
Okay. Yeah. So that's good.
And it would, just like other options in the stock market. And if the option expires worthless, you could have said, well, hey, I wasted that money. My health rating stayed the same, so I just paid extra for no benefit, and you would be right. But how would you know that, right?
Right.
You
most likely
not have a crystal ball.
Later. Yeah, something's going to shift or change in some way. Especially 20 years. That's pretty
a long time.
Yeah. I'd like to kind of go back a little bit on the lending ability. So do you have? I know you work directly with one bank in particular that does collateral lending on whole life.
I actually work with two specifically, but yeah.
You work with two ones. So is that something that you'd be open to sharing which banks, or someone kind of contact you and walk through a whole life IUL?
Yeah, we should probably just walk through that. There's a handful of banks across the country that specifically do it. And then I've actually found local options as well. They're not quite as attractive because they're smaller banks, but you kind of get a little bit more variability with them.
Okay. Love to hear about it.
Yep.
Is this something you'd go over right now?
Oh no, sorry. No, no, we would go through that, as a client consultation or what have you.
Gotcha.
But just
but they have options.
The general point is there's several national, they're not national banks, but there's several banks that work on a national basis, right? If you're in Hawaii or Texas, don't take your life insurance policy as collateral.
And you're saying on average, these banks will lend to you a line of credit as collateral off of your whole life at an interest rate, usually about 3%.
So it's typically prime with an interest rate floor. And as your policies get bigger, they give you discounts. So right now, the two that I use, they both charge 3.
Okay.
But if the interest rates go up, then their rates will go up. Interest rates go down. Theirs don't quite go down because their floor is 3. So they never go below 3. Right.
Okay.
Just like if you get a bank loan, right, even if interest rates are negative, the United States banks, they're still going to charge you interest. They're not going to say, okay, well, because interest rates are negative, here's free money. They don't do that.
But I would like to put this into numbers. So if you had a whole life, let's just
Mhm.
say 100,000, nothing huge, nothing, anything like that. So you had purchased a 100,000 whole life policy, and you said, so you're saying within about a week of opening this up, you could then reach out to one of these specialized banks that actually does collateral against life insurance.
Yep.
And you could lend about 95% of the value of your whole life. So in essence, you could potentially be able to get a line of credit of 95,000 without pulling any money out of your whole life. It's just using it as collateral. So your whole life is still appreciating. And now you have a line of credit available to you at 3% or higher, depending on the prime and interest rate. And so now you have 95,000 line of credit with like a 3 or 5% interest rate, which is astronomical. I mean, which is amazing because line of credits are like, some of them are like 15 or 20%. I mean, they're kind of crazy when you do a line of credit. So, what terms usually is that? Is that like a 3-year, 5-year, 1 year? Do they have a limit?
Yeah, so they're usually a committed 5-year term, and it's monthly interest payments only. So it's a very favorable loan because remember, the banks basically view this as basically cash. That's why they give you 95% collateral, right? If you take the money and you go to Las Vegas and you bet on the Las Vegas Raiders and they lost, or you bet on black and they lost, like the bank is still protected. If you can't make that monthly payment, they just take the policy and they convert it to cash and they pay themselves back. And it's not hard, right? I mean, they're basically lending against the cash value in the life insurance policy. It's super safe for them. So to correct one thing you said, so the example I gave was really, you put in $100 or $100,000, you'll have 95,000 approximately available as cash value. And then at that point, you have a choice. You can borrow it from the life insurance company directly, in which case they would give you the full 95K. But, depending on the life insurance company, their rates may vary, or it might take it out of the policy and you're not earning in the policy anymore. Or you can pledge it to the bank and then they'll give you 95% of the cash value. So you're literally looking at 95% of 95, which is 90.5. So you put in $100,000 and you want to borrow as cheaply as possible, you're going to be able to borrow about 90.5K at 3%.
Because I do want to clarify, if you do not utilize this amazing little strategy that you're sharing with us of utilizing a bank that has it as collateral, if you lend from your IUL, or your whole life, sorry, if you
borrow,
borrow from your whole life, your interest rate is usually like 5 or 6%, 4 or 5, and you're actually pulling that money out.
Correct. So that wouldn't be a very good deal, right? You wouldn't really want to do that.
Yeah, so you're paying more in interest and you're actually taking it out of your policy, but your policy is still appreciating at the full 95,000 or 100,000?
100.
Okay, so
just remember, it's just like a home equity line of credit, right? So even though PNC has like a 60% loan to value on my house, if my house doubles in value, I still get the full equity of the house. It doesn't matter what my line of credit is. It doesn't impact the value of my house whatsoever.
Yes.
It's just like a home equity line of credit. And certain and you know, when you Google, when you kind of look at the horror stories about people losing money in life insurance, number one, it's kind of shocking that people lose money in life insurance because it's basically a safe product that you're not meant to lose money. When you look at it, a lot of times people got oversold policies from their friends or family or you know, non-experts. And a lot of times people are just turning in their policies and getting a much lower amount back. They're basically just like selling a stock at a discount. It's insane. They just don't really understand how to borrow from the policy. It's almost always better if you need the cash, don't turn in the policy, just borrow from it.
Yeah, don't cash it in.
There's no,
because
there's rare, it rarely makes sense to cash in a policy unless, I mean, there are really bad policies out there. I mean, don't get me wrong. There are certain situations that make sense, but a lot of the horror stories you read, those could have been easily mitigated by just learning how to borrow from the policy effectively.
Are there, I mean, I imagine there are, but I just want to clarify. So is it easier to lend from your whole life or your IUL policy?
Whole life, because you can pledge it to the bank. So you have that whole,
Yeah,
you have that whole vertical available to you now. You just go do it tomorrow.
Is there a policy on either or that has like a time frame, like you have to have your policy for 12 months before you can lend from it, or
yes,
like that in play?
Yeah, so out of the two banks I mentioned, one requires you have to have owned the policy for 12 months, and then the other doesn't care. So I used one bank for about 7 years now. And then the other bank I just recently used because I bought a bunch of life insurance on my kids. And the first bank, I told them, you know, hey, can you make an exception for me? I've been a customer for 7 years. I have millions of dollars of line of credit here. And they said, no, sir. And then I said, okay, well, thank you so much. And then I went to the other bank that they don't care. So now I have two credit lines. I have one credit line at one bank with my policies, and then I have another credit line at a different bank that has my kids' policies.
And I love that you pointed that out. So when is a good time to open up a policy for your children? And why?
All the time. I mean, your kids most likely have no health issues, God willing. It always makes sense.
Because we have one for our son, and I kind of just have it in play to loan against it for his car or for college. I mean, that's kind of like his entire fund, really. We just put it into that for utilizing it for investments and things later in the future for him.
Yeah. Or, you know, the examples we give are, you know, sometimes what you're doing is you're locking in the insurability, right? Let's, you know, what if something happens and kid gets leukemia or cancer later on and can never get life insurance? By having it early, you've locked it in. You're just kind of hedging against future risks.
It would not make sense for a child to do the health premium, right? Because that usually only lasts 10 or 20 years, and most likely
they typically won't let you. So the vast majority of companies, the way they do it is if you're under 16, you basically have one. It's basically a yes, no. So if you're under 16, you're either you get standard rating or you get, you know, you're rejected. So kids are basically just the same. They don't differentiate. And then once you start going above age 16, then you can look at what their health dictates and look at their BMI and all that kind of stuff. So when you're 16, so let's say you bought a policy, like for my kids, I bought a bunch of policies from them now. When each of them turns 16, I will then submit to the life insurance company their medical records and then see if I can get them to be a higher health rating based on their doctor's records.
Okay.
And then that will then trickle through their policy, and then they'll start making, so let's say they go from standard to the highest rating, then they will start earning dividends based on the higher health rating.
Gotcha.
And then if for some reason they're lower, typically the policies don't allow the insurance company to move them down. So it's only an upward option. So you can only do better.
That's nice.
Yeah, so it's an option to do better. So make sure your kids are super healthy at like age 16 and then let them do whatever they want. Then they can go eat all the junk food they want.
Right. You're like, I'm already maxed out of what I can make from you. So
yeah. Yeah, because if you get the health rating, right? Because, you know, like I said with my personal example, I'm now at the third highest health rating, which is actually the second worst. So it's not good at all. But that doesn't impact the policy I bought 9 years ago. That's still earning money at, a 29-year-old at the highest health rating. So that is by far my best policy.
Yeah.
So it doesn't retroactively bring that one down.
Gotcha.
And then let's say like tomorrow they come up with a cure for sleep apnea and they zap me with it, and then there's no longer an issue. I might be able to go back up to the top health rating, and then I would drag my current insurance policy back to the top health rating too. So it's a one-way option of you can reapply and make a better health rating.
That's really nice. Okay, I like how
it is. But again, they're not doing it out of the kindness of their heart. I think they're doing it because it's a very low probability, like we were talking about before, right? Yeah. People's health generally declines. So it's going to be exceedingly rare for people to start reapplying and all of a sudden, going from standard health ratings to the best.
That makes sense. I'd like to, just utilizing time, I want to kind of wrap up and end on, when do you feel it would be good to switch over to kind of like a new policy? Like, can you have too many policies, or how much do you like to kind of max out in one policy to then open up another one?
Sure. So a lot of that depends on your own personal financial metrics and stuff. So for me, it was important when I first started, I wanted to have at least 2 life insurance companies because I just felt like I was putting in too much money on one policy. It doesn't really matter unless you get, really large number in terms of what you're actually putting into the life insurance policies. I mean, these are all regulated by the state. So far, in my lifetime, I haven't seen a life insurance company that's not messing with derivatives and things, i.e. AIG fail, which they did fail during the financial crisis, but it wasn't really their life insurance arm. So I would say if you're going to do multiple policies, which I think is always a smart thing to do, what I would recommend is you stagger them in time. So typically the way it works is I don't like paying premiums monthly. I like doing it annually because it's cheaper. There's usually a time value of money surcharge if you pay monthly versus quarterly. And that's the same like with my home insurance or my car insurance. If I pay monthly, I'm just going to pay more. And and if that's your budget, that's your budget. But preferably we want people to pay annually. So the best way to game the system is to then have one policy in January, one in March, one in May, one in July, or whatever. If you decide you're going to do multiple policies, or have one on husband wife, kid, spread them out a little bit. So then what you could actually do is you could recycle the same premium dollars the whole way, right? So let's say I have 3 100K policies, one on me, one on my wife, one on my kid. I can put in 100K in January on my policy, and then my wife's due in March. So then I borrow the 100K out and pay hers. And then I got one in May, and then I borrow it out and pay my son's. So I've used the same 100K the whole time. I never had to put in 300K,
So, I mean, well, how would you, just to clarify, how would you then pay the second year? Because when you borrow against it, it only appreciates so much, and you eventually, want to put that money back in.
Correct. So if you're not going to borrow it to invest in other stuff, right? So typically what people do, especially active investors, is, so here's what I do. I'm pretty active. So I have a credit line, right? And then when I have a deal, I'll write myself a check and I'll use the money for the deal. And then I typically do hard money lending. So I usually get paid back in 6 months. So when my borrower pays me off and I make all this interest or whatever, I then pay off my line of credit because I don't have a deal. And then I wait for the next deal and then I pay it, right? So if I'm using it actively, I'm going to have flows in and out constantly. Now, somebody who's not doing that, what they could really do is they could just, for the first example, they just borrow the money out, pay the second policy, borrow the money out, pay the third policy, borrow the money out, and then just wait till the next year because they're not really using it to invest. They're just keeping it around. Just borrow it again and just go again, cycle-wise. So you could just keep recycling the same, one premium. Now, each time you're going to, you have a little drag factor of 5 to 10%. So you have to subsidize at 5 to 10% for the first few years before it starts, tipping to the other side. But you really, the example I gave you, you're basically recycling like the same $120,000 over and over again. And you have multiple policies with huge death benefits on them.
That is a very fascinating idea. Yeah, because I was always looking at them literally and and not actually utilizing the system itself to then pay for other policies themselves.
Yeah, you could just stagger them.
That's interesting. I actually might take that into consideration as well. So um, that is awesome. I wanted to provide everybody contact information. This has been Ethan with all of this. I super appreciate it, Ethan. I know we had discussed a couple of ideas, and that's why I really wanted to have you kind of describe what you were doing and how you utilized it. And you really kind of, it's taken over what you used to do and how you used to think. I mean, because originally you got into it just for a policy, and now it's how you run all of your investments and I mean, you run everything through it.
Absolutely. Yeah. When I bought my first policy, just like my what I said with Luke, I was like, I don't really care. I'm never gonna borrow from this. This is just extra cash. Like I don't need it. Right. And now I'm like, I need every dollar I can because deals come up. And when deals come up, you want to be able to do them. Exactly. So I mean, so it's almost like my life goal. I want to get every dollar I have into policies so that I can borrow them out. Right. So I'm making that, same dollar in multiple places thing. So if somebody gave me a magic wand and said, hey, Ethan, can you put all of your cash in these policies? I'd say, yeah, absolutely. I'd do it right now.
Yes. Yes. I know.
But they don't let you. Like that triggers tax consequences and triggers the modified endowment contract rules and stuff. So you have to kind of get it over time.
But it's a really good mindset to get into because so many people think this is a retirement. This is something that they use way down the road. But in essence, I mean, this is your lending capacity for everything in your life. I mean, anything you can think of having a loan against. Instead of going and getting that loan, set yourself up and so you are your own bank and your other people's bank through utilizing your life insurance, and those policies are appreciating as well while you're lending against them, and you're setting yourself up for any emergencies or any like health issues or death that happens later on. So it really is kind of covering all the basic fundamentals of life, like everything we need to do. So powerful.
Yeah, the example I like to give more so is that it's a parking spot for money. So when you have money and it's not doing anything, you just park your car, and then when you need to go do something, you take your car out and you drive there, and then you come home and you park again. So I just use it as a parking spot for money, and it's an efficient way of parking money. So I typically keep very little cash at my bank account because I'm either investing it in real estate or I'm paying down my line of credit. Right. So I just have when people complain about, oh, I only earn like 0.01% at the bank, I complain about that too, but it doesn't matter, right? Because I'm either making a bunch of money investing in real estate or I'm saving 3% interest rate on my line of credit.
Exactly. Your money is working in many ways.
So my money is always working. My money is always working at way higher than 0.01.
Yes. Which I love that. Like I said, I think that's a great thing to kind of segue out of it is not only is it a great lending tool, but instead of thinking as a bank of being your reserve, now you switch that thought process, and your whole life for IUL is now your reserve, your savings, your everything. And you can then use that tool in so many different ways. Obviously real estate investing, but it can help you in a lot of other ways on top of that. So I love it. Well, awesome. Like I said, I mean, Ethan's contact information is here. I definitely suggest reaching out to him, and obviously a lot of things are very specific to you individually. So he can definitely help break that down and guide you and tell you, the best direction for you and your future. So Ethan, thank you so much again. Is there anything else you wanted to end on or?
No, thank you so much.
Thank you. I really appreciate it. And hopefully we can, do this again sometime and maybe kind of break something down. But I think this was absolutely perfect.
Okay. Sounds good. Thanks.
Awesome. Thank you. Okay. Let me figure this out. Look at that. I screen shared. And now, oh, it's over here. All right. Thank you so much, Ethan. So